Here now is Manjeet Singh CPA with some tax help for you.
Welcome back. This is Manjeet, and on this Saturday morning, I hope you're not bored with what Ms. Younghans has been educating us on the foreign bank account activities. Most of it earlier, she has given information on what the rules are, what the law is. Today, I'm going to ask her to give us a little bright side of the program about the penalties that she talked were so severe. There is a little lightning in the cloud. Ms. Younghans?
Yes, thank you, Mr. Singh. Well, as I mentioned in one of the earlier segments, there is sort of a whole series of potential penalties involved here, civil penalties, monetary penalties, for not filing an FBAR or for filing one that's inaccurate. Potentially the penalty that the law provides is 50% of the value of the account per year, with some lower amounts if a person can show that his conduct is not willful. Within the offshore voluntary disclosure initiative that the IRS has underway right now, the basic penalty that the IRS is offering people is 25%. And I want to make sure, I think I was clear about this, but I want to be sure it's clear that that's a one-time penalty. It's not 25% for each year you had the account. It's 25% of the highest amount that was in the account during the disclosure period, which goes back to 2003. The IRS has, however, recognized that there are some classes of taxpayers for whom a lower amount may be appropriate. And it's a somewhat narrow two categories, but it's worth knowing that they're there. The first one is what's called the 5% category. So in order to have a 5% penalty within the program rather than a 25% penalty, the taxpayer has to be able to show four things. First, that he or she didn't open or cause the account to be opened. So typically this scenario involves people who inherited an account that was opened for them by a family member, let's say. Secondly, that the taxpayer exercised minimal or infrequent contact with the accounts, so that generally the money just sat there, you didn't go and put money in or take money out on a regular basis. And to be more precise, that you have not withdrawn more than $1,000 from the account in any 1 year covered by the program, which would go back to 2003. And lastly, that the taxpayer can show that the funds that are in the account, if they were subject to U.S. taxation, did in fact have taxes paid on them. So for example, if a person's parent made a whole lot of money in some business and paid taxes on his earnings and then decided to put his money in Switzerland or HSBC or wherever, and those funds passed to the taxpayer who's now interested in this, that would satisfy that component. If the taxpayer, on the other hand, is running his own business and just doesn't want to pay all his taxes and is sending money out of the country now, then he would not be eligible. Those are the four conditions for the 5% penalty. There are also some people who can be subject to a 12.5% penalty, and that is where the highest value of the account during the years in issue is $75,000 or less. And again, that would include not only what's in the account, but any undisclosed foreign assets. So if you have real estate, it's pretty unlikely it's going to be less than $75,000. Right. But at least hypothetically, the collective value of the foreign assets is less than $75,000. The person might be eligible for the 12.5% rather than the 25% penalty.
Ms. Younghans, in the last week, I did some Google search and FBAR penalties or FBAR exceptions and silent disclosure, and I kept on coming up against one case only, and that was Shavo case.
Oh, the case that was recently indicted? Yes.
Just give us a little bit information on that.
Sure. And I think what Mr. Singh is referring to when he refers to silent disclosure, or sometimes called quiet disclosure, and the case he mentioned, is that As I said on the very first segment of this, the IRS has always had what's called the voluntary disclosure policy. And until now, it was just understood that if you wanted to come clean, as it were, you could put together amended tax returns and put them in the mail and attach a check, hopefully, and the IRS would be thrilled. And that you didn't have to raise your hand and identify yourself through the pre-clearance process in the way that this program now envisions. The IRS has been very, very adamant in saying that it does not consider that form of voluntary disclosure to qualify under this program. So if you want to get all the benefits of this program, which we've talked about, the reduced penalties and the assurance of no criminal prosecution, you have to follow the rules of this program. You can't do a so-called quiet disclosure. The case that Mr. Singh mentioned is a case that was just indicted recently where an individual apparently tried to do it the old-fashioned way. He tried to do a quiet disclosure. But worse than that, according to the indictment anyway, he filed amended tax returns that were still incorrect, which is about the worst thing that you can do in this circumstance. And the IRS made a point in the criminal charges of saying that the quiet disclosure mechanism isn't valid. Now, if he had filed completely accurate amended returns, perhaps he would not be the poster child for this point. But
I think I need to emphasize you use the word returns. He should have filed only one amended return with the correct information rather than doing multiple amended returns. One return
Yes.
amended,
Yes.
change that to number 2 amended, then change that to a number 3 amended returns.
yeah, I can't remember in his case whether there were 2 or 3, but there were several. And there is really only one rule that a person can keep in mind when you're thinking about this, which is, if you're going to file an amended tax return, it had better be perfect. And not only with regard to offshore income and related kinds of issues, but if, for example, your tax return also happens to have in it something else that isn't right, and you're going to file an amended return to pick up offshore income, then you better fix that other thing at the same time. Because every time you file a return, you're swearing under the penalties of perjury that it's true and correct. And if that statement isn't true, it's a crime.
Well, thank you very much for the added information. And folks, I hope you're not scared enough, but we have the privilege of staying and living in the U.S. We should do it by the book. And with this, we'll see you next week. I hope to bring some other topics. Thank you very much.